All right. So in our last lesson, we primarily looked at the topic of credit. And I made mention the fact that, credit and credit scores are important because ultimately those of you that someday try to buy a house will take out a massive line of credit called a mortgage. So today, I want to really quickly kind of run down through just some things that you need to be aware of in terms of purchasing a home of your own someday, the costs that are involved, and basically, try to help you kind of wrap your mind around how much money would I actually need to save up to eventually become a homeowner in the Pittsburgh area. Now, of course, in most people's experiences, they don't jump right into home ownership. Most people do start off by renting, maybe living in an apartment, renting a property, splitting a rental with somebody else to kind of get themselves established. But here in Western Pennsylvania, we do benefit from the fact that we have a fairly high supply of properties available, and we have a fairly low population, which makes property values very low by national comparisons. For many of you, purchasing a home of your own and getting a mortgage is probably something that is not unreachable in the next 5-6 years. Now, in terms of renting versus buying, there's inherent kind of pros and cons of each. I always say, with renting, one thing that's nice about it is that it does give you a lot of lifestyle flexibility. So if you make a decision that you feel like moving somewhere, if you want to change careers, or you have some other kind of like abrupt lifestyle shift, it is much easier to change your living situation to reflect that change. With buying a house, that house is yours and you're kind of stuck with that house until you sell it off. So it makes a little bit of mobility more challenging. The other thing in terms of, renting versus buying is of course, to rent, you generally need to save up like the first and last month's rent payments. Whereas with a mortgage, you generally need to save up a significant down payment as well as some money for other expenses too. So it's much kind of harder to break into purchasing versus renting. And then finally, the last big thing that many people view as a pro, but could also be a con, is that if you're renting a home and something goes wrong, well, it's the homeowner, it's the landlord's responsibility to fix it. It's not you that is necessarily on the hook. Whereas if you've spent your life savings and you purchase a home and then all of a sudden you get a big leak in the roof or your furnace goes, you're going to be the one ponying out major additional expenses. So again, just something to kind of keep in mind as you make decisions on where you're living in your living arrangement as you move forward. Now, I mentioned that, like, let's say that you decide that, hey, maybe I'm working full time a few years and I've saved up some money, and then I'm thinking then of going out and buying a home of my own. Well, in terms of kind of starting the process, generally a good starting point is, of course, to review your credit score, to have at least a ballpark idea of where that lays, because that's going to give you an idea of what kind of interest rates you should be able to qualify for. It should also probably give you a better idea of how willing banks would be to maybe lend you the money that you're requesting. And as I mentioned, credit score matters significantly. It can be tens of thousands of dollars difference over the course of the full mortgage. Now, in terms of mortgages, the vast majority of mortgages in the United States are generally issued in two lengths, either 15-year mortgages or 30-year mortgages. And the difference in that you see is that, we're talking either a loan divvied up in 180 payment increments or 360 payment increments that you're agreeing to make over that, prolonged period of time. If somebody, signs up for a 30-year mortgage and you've made all your payments on time and in full for 20 years, but then you have some major challenge that happens and you miss a payment and then another payment and another payment. Technically, you do not own that house until that mortgage is 100% paid off. Instead, it's typically the bank that owns it. And this is where banks do have the ability to do what's called foreclosing on the house, where they then seize the house, basically evict you from it, and then they resell it to somebody else to try to recoup the money that they had previously loaned out. So, foreclosures are something that unfortunately happen a decent amount. They can be very beneficial, especially for new people to get a good value home. But oftentimes with foreclosures, there's many kind of problems that maybe went unfixed from the previous owner. So just something, again, to kind of keep in mind about as you move forward. You agree to a 30-year mortgage, you're on the hook for a lot of consecutive payments. Now, of course, the benefit is that a 15-year mortgage, generally, your payments are going to be higher per month, but usually your interest rate will be significantly lower. And again, you will oftentimes save tens of thousands of dollars in interest over the course of the loan compared to a 30-year version. Some other things that you'll need to do is you'll need to go into the bank, a bank or whatever financial institution you're working with, and you will need to get pre-approved for a loan. So they'll have you oftentimes bring in copies of your paychecks, and they'll have you bring in maybe a copy of your tax return, and they'll do a credit score check. And they will then approve you for a certain amount that, hey, we will lend you up to $150,000. We'll lend you up to $200,000. Now, one thing I always say to people you got to be very, very careful of is that just because they have approved you for a certain amount does not mean that that is what you can really afford. I mean, you might have, if you have two kids that are in daycare, like those are two major, massive other expenses that are part of your monthly budget that maybe the bank doesn't know about. So just because you're approved doesn't mean that that is what is going to put you in a financially comfortable situation. Another thing that you'll want to do after you get pre-approved or in conjunction with getting pre-approved is you will most likely also want to enlist the services of a real estate agent. Now, as a buyer, you will not pay any money out of pocket to have a real estate agent work for you. Where a real estate agent gets paid is that they get a cut of the commission on the sale of the home. So typically a kind of standard commission amount for sale of a home is about 6%. So if you're somebody that, is selling $100,000 home, instead of you getting $100,000 when you sell that house, instead you're going to get $94,000, and the real estate agents are going to get $6,000. And then typically what will happen is that the seller agent will get half, and typically the buyer agent will get half. So both, will take $3,000 as payment for the work that they did on the sale of that home. Okay. So as a buyer, you're not losing any money whatsoever by having a real estate agent working for you. I've always recommended having one because they will oftentimes notify you when houses that kind of have your preferences pop up on the market. They can maybe steer you away from properties that they know have some inherent problems, so you're not wasting your time. They'll also help you fill out all the forms and make sure that everything is legally correct. So a good real estate agent is definitely worth it to employ, at least from my vantage point. One thing, though, that you do need to keep in mind is that a real estate agent is vested in trying to get you to buy a house. So let's say that you're somebody and you're looking for a perfect house and you've looked at maybe 40 or 45 houses with this agent. They might try to press you into making an offer and closing a deal, even if something's maybe not perfect for you, because they want to get paid and they want to move on. Sometimes you'll also see people, and I know this happened, for instance, with some family members of mine, that were kind of perusing the market. They weren't sure if they wanted to buy a home yet or not. They went to a few open houses, and instead of enlisting a real estate agent of their own, they said to the selling agent, hey, would you like to represent us too? And that way you get to keep all 6%. And what that did was it gave them a little bit of additional leverage to try to say to that agent, hey, get us a lower price. Like, let's see if we can get a lower price. You get to keep more on your end. And maybe we can use as a way of kind of, again, getting a better deal. So just something that you want to be aware of, that real estate agents, yes, they're working for you, but they're working on a commission. They're trying to make a sale. Now, in terms of costs of buying a house, so of course, the main cost and the biggest impediment to buying a house is you need to save up a down payment. The bank is going to want a certain amount of money in cash in order to close that mortgage. Generally speaking, the recommended down payment, and many people don't have this amount, so don't feel like it's a necessity, but a recommended amount to try to save up is 20% of a house's value. Now, why that's a recommended amount is that typically if you have under 20% of a down payment, the bank is then going to charge you per bill something called mortgage insurance. So you might end up paying an extra $100 a month, if not more, just to insure your mortgage in case you default on it and walk away and the bank forecloses. So they want to see 20% because that means that you are really vested in keeping the house and paying your mortgage on time, and that you're not going to walk away from it easily. I also put here a reference to money in hand. So let's say that you come across a house that you want to own, and you decide, all right, I'm going to put an offer on this. They're asking for $100,000, but I'm going to offer them $90,000, and we'll go from there. When you put that offer in, one thing that will make your offer stronger is if you give what's called money in hand. Okay, so this is money that if you decide later on to walk away from this, if you decide, you know what, this house isn't for me after all, the seller gets to keep that money in hand. Okay, so if I say, hey, I'm going to offer you $90,000 for that $100,000 house, but $5,000 of it I'm going to give you in hand, well, that seller knows that, hey, this person that's trying to buy is serious. Like, they are going to follow through so that they don't lose their $5,000. So again, something that you want to keep in mind. Now, after you make an offer, if that offer is accepted, you then usually have a period of time to then go and get a home inspection. Okay, and a home inspection is something that, again, you are going to have to pay out of pocket. Now, I purchased my home 14 years ago, so I forget exactly how much I pay for a home inspection, but you're probably looking, $500, $600, something like that for a good inspection. And the home inspector will come out and they will inspect that house from top to bottom. They'll look into the plumbing and the roof and, the foundation and the electrical, and they will write you up a really big report of everything that they see problematic with that house. Now, at this point, based on the inspection, you have the ability, if you want to walk away. You can say, you know what? Too many problems came up in this inspection. I don't want to go through with this. And all you would end up losing then is your in-hand money. Okay. And of course, the cost of the inspection. Now, you also have the ability at this point to go back to the seller and the seller agent and say, you know what? They found all these problems. I'd like to renegotiate my offer. Or, hey, I'm still willing to give you $90,000, but I expect, the seller to fix this, that, and the other thing before we actually close on the mortgage. Okay, so you do have that wiggle room there, kind of right after the inspection. And then finally, the last big cost that you're going to have to factor in, and some people simply just roll these costs into the mortgage loan itself. Some people like to bring this money, in hand in cash, and that is the closing costs and all sorts of taxes. Now, closing costs basically are a whole slew of costs. I mean, it's crazy. When you're sitting down to sign off on the mortgage, you'll see pages upon pages of all these fees and taxes. Literally, everybody gets their cut. The real estate agents get their cut. The different government entities get their cut. There's all sorts of additional fees. There's different lawyers and licensing firms that get their cut. So you will oftentimes pay thousands and thousands of additional dollars just to finalize that mortgage and to make it official. Many mortgage companies will also require you to pay upfront an entire year of property taxes, which go into something called an escrow account. So again, I forget the exact number, but I think when I closed on my house 14 years ago, I think I was paying upwards of $5,000 in just closing costs in order to secure that loan. So money that you would need to kind of factor in as you save up and think about making a purchase. Now, the $1 million question then that people ask or students ask all the time is, well, how the heck do I know how much I can afford? Like, I'm driving around, I see these houses, I see a house being sold for $200,000. Like, how do I know what I can afford on a monthly basis. Well, typically when you get your mortgage bill is not just going to be for the loan of the house, or at least for most people, it's not going to be just the loan of the house. Typically, you will also have factored into that mortgage bill two other major expenses as well. You will have your homeowner's insurance divided by 12, so evenly spaced out, and then you will have your yearly property taxes, again, divvied up by 12, spread out across each bill. So with property taxes here in Western Pennsylvania, that's a big one. Other states, other parts of the country, it's not as big of an expense. But here in Western Pennsylvania, as any of your parents or guardians will tell you, property taxes are a huge expense. So you will pay not just one set of property taxes, but rather you'll pay three. You'll pay property taxes to your local municipality. So if you live, for instance, in Shaler Township or Etna Borough, they'll get a small cut. You'll pay some property taxes to Allegheny County. And then the largest set of property taxes will go to the school district. So Shaler Area School District is overwhelmingly ran by property taxes of the people who own property in those four municipalities. So this by itself, property taxes can easily add hundreds of additional dollars per month to your monthly mortgage bill. So you'll pay, a principal payment, you'll pay some interest on that principal from the loan, you'll pay the homeowner's insurance, and then you'll pay the property taxes as well. So you always, when you're doing calculations and you're trying to figure out, how much can I afford per month, you need to factor in all of these potential expenses. And I made the note here at the bottom of this slide, we talked about in the last presentation, always keep in mind when you're trying to figure out how much can I afford, that whole debt to income ratio. I mean, you want, housing probably to make up, under 20% of all of your overall income on a month-to-month basis. So again, just kind of a rough estimate there. Now, the last thing that I always point out, and this is also going to be tying into a little assignment that we're going to be doing next week, is that students, I think one of the frames of reference that we lack when we're young is value of something. Unless we really research something, like we don't really have an idea of the value. Like we look at a house that we're driving past and it's like, well, what is that house worth? Well, I listed here on this slide, a lot of factors that typically impact the value of a home. Of course, one thing that is always important is lot acreage. So how big is the land that comes with the house? So in a suburban area, like, our school district, probably the vast overwhelming majority of homes, we're probably talking maybe a quarter of an acre in size, maybe a half an acre in size. If you have a plot of land that's an acre or more, that's generally a fairly decent plot of land for most suburban, urban fringe areas. And you see there an acre is simply equivalent to 43,000 feet. So generally the larger the lot acreage, the more the value that commands. Oftentimes, number of bedrooms and bathrooms, generally the more value. Newness of renovations, especially newness of renovations and age and condition of big cost items. So, if you have a home where the previous owners, renovated the kitchen and put in a new furnace and totally redid the electrical system, well, they have paid a lot of costs to make all of that stuff nice and new. So that, again, adds a lot of potential expense to the overall value. Things like road traffic and noise. We know cul-de-sacs and dead-end streets tend to have higher demand for them than maybe really busy thoroughfares. So again, something to keep in mind. School district, I always say to students, well, why should you care about something like standardized test scores? Like why does that matter to you? Well, it might not matter to you directly, but any property owner in the school district, it matters to them indirectly. Because if somebody's moving into an area and they're trying to figure out, okay, I'm not from Western Pennsylvania, where should I live? What is one objective piece of data that is going to help them get an idea of school district quality? they're going to look at things like standardized test scores. So, you have the same house in an NA and you plop that same house down in Wilkinsburg Borough, you're going to have, significantly different values just based on the school district in the area. I put general location, ties into things like, flood areas, in our district. Proximity to floodplains is a big deal that affects value because it might make it so that you have to have flood insurance, which is another massive cost. Neighbors, you can't control your neighbors. So neighbors, unfortunately, can impact the value of a home. So something to look into as well. I remember somebody gave me the suggestion once, if you're ever thinking of buying a home, drive past that home, drive down that street on like a Friday or Saturday night and just kind of see what's going on, see the level of noise, see the level of cars out and about. So again, just a recommendation that was given to me once upon a time. And then finally, things like air conditioning, if it has it, obviously it's going to have more value. If it doesn't have, it's going to have less value. In Western Pennsylvania, things like well water or septic systems. Now, some people have no problem with well water or septic systems, and it doesn't really impact their demand for a property whatsoever. Other people are wary of it and want to stay away from it. So again, things that, if you ever come across a property that interests you that has a septic system, know that that's a whole nother thing that you need to kind of research that might have some inherent pros and cons and costs. Now, in terms of moving into next week, so next week, we're going to be doing a little assignment, basically giving you the chance to kind of explore some neat tools and things that are out there on the internet right now. Some tools, frankly, that weren't overly available to people 10, 15 years ago, that frankly give you a lot of access to knowledge, and knowledge is power, and knowledge can benefit you significantly when purchasing a property. The assignment is also going to have you looking at kind of what is out there in terms of houses that are currently sold, hopefully making it so that you get an idea of property value a little bit better, and also having you calculate, how much a house would cost on a monthly basis, given some of the data that we have about it. So I wanted to show you just really quickly 3 of the websites that we're going to be using in that assignment next week. The first one is the Allegheny County Property Assessment website. So the county literally keeps records on every single property in Allegheny County for the purpose of property taxes. So if you know an address, you can go to this site and say, I agree. And you can, put in house number, put in the street, put in the municipality. All right. And you can pull up a whole bunch of information on that property. So you see, like this one I looked up, it's just somebody I know. You can see the name of the person that owns it. You can see how much they bought that house for. You can see when they purchased it. You can see the lot size. So this one's 30,500 square feet. You can find how much the county is assessing the value of that house. So this number here is the number that they base your property taxes off of. So as a homeowner, of course, you want that number to be low. But at the same time, when you sell the house, you want the house to sell for much larger than is maybe represented here. You can get some information, these other tabs, building information. So you see the living area, it tells you stuff if it has HVAC, built-in, condition, year that it was built, etc. You can pull up an image of the home in the floor plan. And so those of you that maybe ever renovate your home, like I added, for example, a deck onto my home a number of years ago. And part of the reason why they have you get a permit and get everything approved, usually through your township, is that then reflects on the site, and it also reflects in the amount that they tax you in terms of assessing the value of your property. So you see all that here, and then you can also see previous owners and how much those previous owners bought and sold the house for. So that gives you a lot of information that will help you get a sense of, is this home that I'm thinking of buying a good value? Is it worth what they are asking for? Another great, general informational website is a website called Zillow. So this is just a national website. And again, you can type in any address in the United States and it's going to give you all sorts of information about it. And at the same time, it's going to kind of give you what they call a Z estimate, where they're going to aggregate the sale of similar houses in your area and tell you how much they think your house is worth. And then finally, the last website that's a good one that I'm going to have you use is just a general real estate company website. I'm going to have you, for the purpose of this assignment, use Howard Hanna, and you're going to be able to go in and you're going to be able to search for whatever kind of house you want to look for. So if you feel like looking at, some McMansions over at Fox Chapel, you can. If you want to search for some homes in Shaler Area School District, you can. So I always go to this advanced search option. And you could come over here and you could type in, Shaler Area Schools. You could specify lot size if you want. If you want to make sure it's a single family standalone home, you can put that. You can put, a price in. So maybe I'm going to put in $200,000. And it's going to show you then all properties that are currently for sale that match your criteria. So you can go on down to one of these, you can click on it, and you can get a whole bunch of additional information. So again, we'll save that assignment for next week, but I think you'll find this to kind of be an interesting look at real estate in this area and how much things really cost.